Hi everyone. Before we start today's episode, I just want to share a quick behind the scene moment. We actually had a technical failure with one of our main video files for our guest. For the first half of the video, her camera angle had a corrupted file. But because we always believe in having a solid blueprint and a backup plan, we had a separate audio recording ready to go. So just like life and aging, things don't always go as planned, but it's the blueprint and the preparation that will keep us moving forward. So while the visual might look a little bit different, the expert's insight from the episode is fully intact. So without further ado, let's get into the episode.
Aging is an art, and your future deserves a blueprint. Welcome back to Graceful Aging by Design, and we often spend our younger years focused on paying off our mortgage, right? But I think as we enter our 50s and 60s, that home becomes more than just a shelter. It actually becomes one of our most powerful financial tools.
According to Stats Canada, like for average Canadian household, real estate accounts for more than half, like 50 to 70% of the total household assets. So did you know there are ways to access that equity without selling your home?
Well, here today, we've got Jordan Thomson with Citywide Mortgages, and she is a strategist as well as a mortgage broker. Welcome, Jordan.
Thank you, Corina.
Oh, you're welcome.
Thank you, Frank.
Yeah. So for a senior who owns their home, clear title, and has high equity, how should they view their mortgage differently than, like, say, someone in the early 30s?
Well, certainly when you're in your early 30s, it's your first home and it's a very long horizon, and you start out with a mortgage, and it's going to be something that you think, okay, I'm going to have this mortgage for 25, 30 years. And my aim is eventually I need to pay that off. It's going to be one of my largest expenses. It's going to be something that I really have to make sure that I can cover every month. And it's a big liability in your balance sheet, right? It's often our biggest financial move that we make. And so we're just kind of starting out. By the time you reach, 55 or 60, 65, whatever, you've likely paid off the majority, if not all, of your mortgage. So now your home becomes like a cushion. It's where you hold your greatest asset. You've just spent 20, 25 years paying it off, or actually you can almost think of it as paying into it. I think people don't understand that. We pay money into an investment account or our investment portfolio every month or whenever we can. And it's the same with a home because it is that forced savings. So now we've got a clear title home or a very small mortgage that we have paid down for decades. And now we're sitting on a big bank account. Right. We kind of won the lottery here too in the Lower Mainland, right? Yeah. We've got that big cushion. Now, what do we do with it? We no longer have that big liability. So now what can we do with it beyond it just being a home if we need?
So before we start the podcast and we have a private chat, and we talk about like a lot of seniors have the mentality back in like 70s and 80s when the inflation is high and the debts are the enemy. Should they still remain that mentality, or what's the real enemy they are facing when they are heading into retirement age or senior age?
The reality today is that we are living much longer than we used to, and I think that that's going to continue. I mean, how many people do you know in their mid-90s, late 90s? I don't even know who it is, but I have a friend whose parent is, finally just passed away at 106 recently. That's really old. And our retirement savings, unfortunately in Canada, for a sole individual, I can't remember the stat exactly, but it's about $30,000. For a family, a couple, it's about $500,000. So we're living so much longer and we don't have the financial resources to last that long. And so the real issue is that we've got inflation. It's not very high right now, but our savings is not lasting long enough. So it's illiquidity. It's cash flow. It's just, it's really cash flow, right? Pensions just are not that big, and people just don't have the cash. And then we've got, medical costs that are very expensive. And how do we pay for that?
Yeah, and most of the expenses are unexpected. That's the most important thing, right? So, a lot of people heard about reverse mortgage. And is there any other structure or any financial tools that can help seniors to access those without really selling the home or need a traditional back, like when we need to have an income and to qualify those financial tools? Is there anything we can do?
Yeah, I actually want to start with the bank mortgage that you mentioned, or the bank financing, because I do work with a lot of seniors. So, between 60 and 65, if somebody comes to me and they have a good job and they don't have a home equity line of credit yet, they've got quite a bit of equity, we're always going to try to get them a home equity line of credit so that they can access the asset that is their home. So I like to start with that, because you can then take the reverse mortgage that I'll talk about a little bit more. And if you use that HELOC, you can switch one for the other down the road, right? Which is great. So yes, if we can get a home equity line of credit, let's start there. But a lot of times that's not practical, because like you said, they don't have the income to be able to do so. The bank looks at income, bar none.
Yeah.
And if you're just living on a pension, it's not that much. It's not enough to really, get that much. So we can look at the reverse mortgage, which is equity based. It's based on the amount of equity that you have in the home, and it's also based on your age. So at 55, you only need to be 55, you're going to get a smaller portion than somebody who's 80. And they do this specifically so that you're not going to run out of equity. If you get it at 55, you're not going to now be 75, and your reverse mortgage, something I like to call a retirement mortgage, you're now 75 and you owe more than is the equity in the home. And that's not going to happen, right? So with the retirement mortgage, you can access the equity without required income based on the equity in the home, and it's payment optional. So that really goes to what you were talking about, or we discussed, where the cash flow is a problem. And there are 3 ways you can access the equity in your home from using a retirement mortgage. So it depends on what you want the money for, and that's how we're going to set it up, right?
So in your experience, before we have a chit chat, you kind of shared a story of how you help your clients with a retirement mortgage. Could you tell that story again, and so that our audience be able to see how can they use a similar tool to help them in their life?
So this was actually something that a lot of people don't even realize. It's when you have that big home and you need to move to a smaller home or right size, what you do, Corina, how you help people move into what's right, or maybe even stay. But in this case, these clients needed to move because the gentleman was no longer comfortable going up and down the stairs in their beautiful home. And it wasn't a question of, when can I do that? It needed to be done now. The problem at the time was the market was really bad and they couldn't sell their home. And it was okay, it was time to move, but they couldn't sell their home. And he really needed to move closer to his doctor and into a rancher to allow him to move more comfortably. So what I was able to do, because their home, they'd had it for quite a while, it was, had a lot of equity, I was able to take the equity from the home that they currently lived in to fully purchase their smaller home. So they could do that on their timeline when they needed, and they just left the home that they moved from They just left it until the market improved, and then they were able to sell it much more quickly and easily in a market that was better, and they ended up actually doing better financially as a result. So a lot of people don't realize that because I can take the equity from the one home and literally just kind of move it over to the next, they can keep that home, and they're not having to leave one home and move into another home in 1 or 2 days, which is typical when you're buying and selling, right? You want those dates to line up, the money has to line up. And that's just when you're 80, it's just not that easy to move out of your house that quickly. And dates aren't always going to line up, right? So in this case, it wasn't the market that dictated when they moved. It was really their health concerns and their desire and their need to move. So we were able to do that very seamlessly and very quickly, I might add.
And you put the control back to their hand rather than market force them and control their options.
Yeah. And I think the key here too, Frank, is that with their new home, once they were able to sell their first home, they actually just paid off. It was set up so that they could just pay out that mortgage that we had to put on their new home. So they didn't end up having a mortgage at the end of the day. It was really a measure that allowed them to have that flexibility, right? So they were able to do that, but they would have never been able to do that with a bank product. In fact, we had to pay off their bank product, right? Which was killing them because now their medical costs were so much higher, right?
And that's one of the major unexpected expense most seniors are facing, and that's they are worried about.
I love that. So I loved that whole story because it was just the right thing to do, and it was
And then the senior just want to have options and the security, and they know that there's something on the market or something in this, be able to help them to do that transitions seamlessly, right?
They don't realize that it's there.
So just another scenario, I meet a lot of clients who tell me they call age in place. But one of their options could be moving into retirement community. But as we know, if we're looking at the monthly costs of a private, independent, or assisted living community, it can range, right? $6,000, $8,000, $10,000, $12,000 a month. So can they use the retirement mortgage then to, for example, put in a stair lift or an elevator or ramps in their home so that they could age in place safely?
Yeah, absolutely. With the retirement mortgage. So we have a few providers in Canada. It's not, we don't have as many as, the big banks that you see around and all the lenders. There is no question. They don't say, well, why do you need this money? We already know why you need this money, whether it's, just paying your monthly bills or renovating your home so that you can age comfortably in place. So there are a couple of ways you can access the equity. We can take it out as a lump sum. So I need $50,000 now to renovate and do a ramp or do the elevator or whatever. We can take that $50,000 out now. Or we can say, we're going to qualify you for $300,000, for example, and when you need it, when the renovations come, or as you continue to require those renovations down the road, then you can take out what are called draws, right? So, well, maybe now I need $50,000, but maybe in a year I also need another $20,000. So you're not having to constantly redo the mortgage, right? We just do one, and you take it as you need it. And then the last reason, or the last method that we can use is actually giving yourself a supplemental income. So we can take just $2,000 per month, and it just gives you that income. So you're not paying for $50,000, $100,000. You're really only paying, because you do pay interest. It is a mortgage, and I can't explain why. It's paid, like at some point I have to pay it, right?
Yes.
But you can just add it to a monthly income, right? Which then can allow you, if you need people to come into the home and you're paying medical costs, you've got a carer that might be $3,000 or $4,000. okay, well, I'm going to have $3,000 or $4,000 come from my home to help pay that medical expense.
So what's the difference when you utilizing that tool when people have RSP or RRIF, because they still be able to use that as to supplement their pension. So what's the difference?
Right. And here you really want to work alongside your financial planner. I work alongside financial planners. Sometimes RSPs, for example, we talked about a few statistics. We have about $100,000 in our RSPs. And we're 70. We got 20 years to go. It's not going to cut it, right?
Yeah.
That's one of the reasons. Also, if you're going to take out large, and it really does pertain more to those kind of larger sums, you are taxed on that by the government. Yes, there's a tax-free threshold, but if we're, taking out beyond that, you will be taxed. And so that's going to obviously reduce the amount of money you get. And it can impact your CPP and your OAS because now you've just told the government, well, hey, I made $150,000 last year.
Yeah.
I don't need so much CPP and OAS. So you definitely don't want to impact that as well, right? So the equity in your home, this is tax-free dollars. So $200,000 from an RRSP is definitely going to cost you a lot more in tax. $200,000 from your home is entirely tax-free and does not affect the CPP and OAS entitlement.
Oh, great. So that's really good to know that you'll be able to have a double win, like you preserve your OAS at the same time. You don't need to draw as much from RSP, and you can reserve that for your future as well. Because I know based on RSP and the RRIF calculation, probably the tax-wise, they calculate about age of 90s. I think that's how they calculated. But like you said, we maintain our life much longer.
Right. When you take money from an investment, that investment is no longer growing. Right? So if you had $200,000 and you took out $100,000, well, now it's only growing from the $100,000. So you've lost its ability to build, whereas the home, if you take $100,000 out of your home, the equity is still increasing from where it was. It's still $1 million home.
Yeah.
Right? It's not a $900,000 home now, right? So that's another big thing, because if you wipe out your investments, well, you're starting from scratch.
And you live at the same house, which is also appreciated in longer period of times. So you still have asset appreciation.
You have asset appreciation. Thank you. That was the term I was going for.
So you did touch on one of the concerns that people have when they're looking at retirement mortgages or reverse mortgages, that they're worried that with the money that they're taking out, then they will have nothing left in their home, right? When the time comes to either sell or they would like to pass some money on to their kids down the road. Maybe can you touch on that, and also what the interest rate is like? Because that's another question that some people ask.
Right. Because it is a mortgage that's made for people who are 55 plus. At 55, you're going to get a very a small percentage of the home value. As you get older, it increases to a maximum of 55% of the value of your home. But you need to be 80 to hit that number. Or it could be, it's at 80, it caps out. So as you said, the equity generally is increasing, and you're never going to owe more on your mortgage than the value of the home is. And that's because the lenders actually have a no negative equity guarantee, right? But it's because they keep that loan to value fairly low. Yeah, the negative equity, that is absolutely something that happened in the States. And that's what people automatically think. Oh, the bank's going to take my keys because, the home value went down and I'm going to owe more and my kids are not going to have anything and I have nothing to pass along. That is not the case in Canada. Very, very different. As for the interest rates, they are a little bit higher. if you take like a 5-year term mortgage, we do have what's called an open mortgage, just like an open mortgage at the bank. So for example, in my story that I used earlier, we knew that the couple who wanted to move closer to their doctor, we knew they were selling their home. So I'm never going to put them into a 5-year mortgage.
Right.
They're going to be selling, and of course I'm working with their realtor, right? I'm not making these decisions alone. This was purely a strategy, and he said, listen, this is not a good time to sell, right? And then you have people in and out, and it's disruptive to the seniors' lives. So we put them into an open mortgage so that the moment they did sell, they could pay off without any penalty. So we look at what makes sense, right? And the open mortgage rate is the same, or very, very similar, if not even a little bit less, than the bank's open mortgage rate, which we do put people into. If they're selling their home and their mortgage is coming up for renewal, again, I'm not going to put them into a 5-year term. They've got their home listed for sale. Why would I do that? That's going to cost them tens of thousands of dollars potentially. Yeah, so the rates are a little bit higher, but you do need to realize you're not paying the bank for like 10 years.
Yes. Yep.
Right? So
you have to weigh.
You do, and it is that flexibility. But you are able to pay the interest monthly if you so choose, and you can make lump sum payments to bring your balance down, just like a regular conventional mortgage.
Okay. So, well, it sounds like there's a lot to know, and they need to reach out to a professional if they want to talk about what a retirement mortgage looks like and how it can help them. And the takeaway I feel from our conversation is that your home can work for you right down the road just as much as you worked hard for your home. And the home equity, getting access to it, isn't really about being in debt. So the mindset's not about being in debt. It's about strategically unlocking the resources that you already had, that you've paid for, right? And use it at a time of your life to fund what your lifestyle, so that you have dignity, so that you have choice and options of what you want to use the money for.
So if you are starting to consider using your home equity as your tool, or you take the control of your retirement blueprint, that we will include Jordan's contact information and some of other helpful resources in the description below. So don't forget to subscribe as we continue to design a better way to age. And thank you so much, Jordan, to be with us today.
Thank
Yes,
you.
thank you.
Thank you.
A huge thank you to Jordan Thomson from Citywide Mortgage Services for joining us today. We appreciate her coming on the show to share those high-level mortgage strategies with us. Here are your design insights. As we age, the role of a mortgage shifts from a heavy burden of forced savings into our largest matured investment. After decades, that equity in your home becomes a strategic safety net. It allows you to finally unlock that investment right when you need it the most, turning your house from a place you pay for into a tool that pays for you. We are now living longer and longer, and because of that, debt isn't the enemy. Illiquidity is. Traditional savings like RRSP or RRIF can often run thin, leaving many house rich and cash poor in a home they cannot afford to maintain. By using a mortgage or HELOC as a lifestyle bridge, you turn an illiquid asset into cash flow needed to maintain your standard of living without ever having to sell. Choosing the right tool depends on your specific financial blueprint. A home equity line of credit offers lower interest rate and flexibility for those who can manage monthly payments and meet bank income tests. Alternatively, a reverse mortgage, or sometimes referred to as retirement mortgage, may come with higher interest rate that can compound over time, but provides tax-free cash with no mandatory payments or income checks. Note, there is a common misconception about reverse mortgage. Many fear a reverse mortgage means leaving the next generation with nothing. However, in Canada, these are heavily regulated tools where you retain 100% ownership and title. With a no negative equity guarantee, you and your heir will never owe more than the home's fair market value, making it a protected way to access your equity while ensuring your estate remains secure. When you need cash, the source matters. Pulling from your registered investment counts as fully taxable income and stops that money from growing, whereas borrowing against your equity is completely tax-free. This allows your home to continue to appreciate in value while you still own it, creating a double win for your long-term financial stability. At the end of the day, there is no one-size-fits-all. You need a team, a mortgage professional who understands the Canadian landscape, a financial planner, and a tax expert. That is exactly why we started this channel, to help you find the right people and the right plan. So if you have any questions or topic suggestions, reach out in the comment section or email us at gracefulagingbydesign@gmail.com. If you found this information useful, please like and subscribe. It'll help us grow and reach more families who need these information. Thank you very much for watching. We'll see you in the next episode.